All right, Prashant, we are live. Thanks for joining me on the show. The floor is yours to kick us off. Why don't you introduce yourself, who you are, what you do for my audience? You can give it pretty high level just to kind of understand, how you got to where you are today.
Sure. First off, thanks so much, Connor, for having me here. A pleasure to be here and talk to you and your audience. So, my name is Prashant Agrawal. I am a former banker. I was a corporate banker for 2 decades. I then left banking, became a consultant, and I have been working with multiple industries and domains over the last several years, trying to help from a strategic direction and strategic planning point of view. More recently, my work has been very focused on startups and small businesses, working with them, trying to build their business strategy, trying to support them, develop their business modeling, their investing processes, their investability, and also being very focused on how the businesses could become fundable, so monetization and everything around that. One of the things that I also do with the startups is help them improve on their pitches because they generally have a pitch and they are either married to the problem or married to the solution, and sometimes not addressing the audience very well, and depending upon which room they are. So I do a lot of work on that as well. So that's at a very high level. And aside of that, I would also add that I do a lot of mentoring and coaching work. I work with the multiple universities. I also work with associations, which are very focused on startup development and entrepreneurship development. So I really find that rewarding, and it's almost like paying back to the community and paying back to the society in my own small ways. So I contribute a lot of time in that as well.
I think super helpful. So, let's kind of pivot and talk about starting a business since you deal so much with different founders. And I think for me and, many people that may not have experience in the space, when I hear startup, I think SaaS product, I think software product, technology. I'm going to build the next Airbnb, the next Facebook, whatever it is. In your experience, are those the types of founders and businesses you're working with most often, or is it really wider than that? It's all different types of stuff. Maybe you could speak to that really quickly.
Sure, sure. So I think startup just as a terminology, and it's funny. I was having a very similar conversation with somebody just yesterday, and this person was based out of the Silicon Valley in the early 90s. And I'm just giving you this example because startup as a term came from the Silicon Valley probably in the mid 90s when there was this is the pre-dot-com era where people were trying to build technology businesses. A lot was to do with hardware and some software at that time. So startup as a terminology is not new. However, it has sort of taken a very unprecedented popularity in the last decade or so, and everybody does have this misnomer that a startup means a technology company. I'll give you one more fun fact. I built my first business when I was 17. This was again late 90s. And at that time, businesses outside of the Silicon Valley were not called startups. Like I was building a business, not a startup. So there is this misnomer that if you are not a technology company and if you are not a SaaS product, you are not a startup. However, if you look at it closely from an industry standpoint and from an expert standpoint, as long as you are building a tangible business trying to solve a real problem with tangible solutions, you are building a startup. And the whole idea of building a startup is you start as a series of small experiments, as a series of customer discovery and customer validation, and then that goes from there and becomes a company, corporation, association, whatever shape and form and corporate structure it takes is sort of next steps. But starting the startup is almost like a series of small experiments and customer validation journey put together.
So let's stay on the tech stuff for a second. And so maybe for someone that is uninformed, and they just have it in their mind, I want to be a founder and I want to be a technology founder. Maybe you could speak to some of the downsides of that model they may not realize. I mean, what does it take to even get that off the ground and build something that is a viable software product, for example, or something that has potential to scale and be a viable product?
Sure. So if you are okay with it, I would probably give you a slightly controversial answer.
Yeah.
And the reason I say that is because starting a startup or starting any business with the idea that I am going to build a technology product perhaps used to work a decade ago. It's not the, I wouldn't say it's the right way to start any business. So when I hear people come to me and say, hey, I want to start a technology startup and I want to build $1 million company, my first question to them is, what is the problem you are going to solve? Explain the problem to me, explain your solution around that problem, and then we will talk about whether the solution works, whether the problem is large enough, how you will make money, how will you scale up, etc., etc. Using technology as an augmentation tool to solve the problem is what I advise startup founders, or I would say aspiring founders, because unless they're very clear about the problem they are solving, using any technology is not going to result into a profitable business, right? I'll give you another example, kind of building on the question you asked me. Very recently, I've had the privilege of mentoring a lot of startups over the last couple of months, and some of them have come with this idea that there are these five different social media platforms, and I am going to use AI to integrate these five social media platforms into one place where I can save the user effort towards using, let's say, one piece of content, but almost repurpose and recirculate that content through five platforms. Just to give you an example. Now, good idea. Perhaps there is value in it for people who have multiple social media channels and multiple use cases for it. But when you look at just this idea alone, there are at least 100 people who are trying to do exactly the same things because of the same thought process that I am going to use technology to build a company, right? And this is where I advise them against and say, hey, tell me the problem you're solving, tell me how big the problem is, tell me the solution, and how will that solution sort of give you that competitive edge and take you to the next level of scalability and profitability. Because if 100 people are doing the same thing, there is nothing unique in it. It's almost like you're fighting for space in a crowded room, right? So maybe slightly longer in answer to your short question, but I hope that helps.
Yeah, I think that helps. I mean, let's take it one step further. And you're meeting with somebody, and you say, okay, you've identified a big enough problem and feel that you have a solution for that problem through technology. What does it then take, in your experience, to build viable technology? I mean, let's say this person is a non-technical founder, so they don't have any coding background, and yet they want to build this. So what does it take to maybe find that technical partner? And then from a resource time perspective, I mean, what's realistic in putting together a viable software product?
Sure. That's a great question. So I'll give you a recent example. I had a founder, a first-time founder, who has had a successful retail business over the past, I would say, 10, 12 years, and reasonably like mature person, understands the business, and this industry that they were operating in is beauty products, right? It's a non-tech brick and mortar business that they were operating. So this person came to me and said, hey, I have this brilliant idea. I want to build a platform where I can bring my customers and suppliers together, and I can build a referral model on that platform, and then I can build almost like a reward program based on those referrals, just to give you the idea at a very high level. Now, this person is non-tech. This person doesn't understand technology beyond using their cell phone, and this person has no technical partnerships or technical products that they use just in general. So the approach my company and I took is, we first went through their current business model. What are the some of the things that they're already doing, and what's the kind of technology they're using. Then we went through a detailed understanding of their business idea. what is the business validation? Have they actually done any kind of customer discovery? And quite, we were quite impressed that this person had actually reached out to approximately 200 of her customers and her suppliers to share this idea at a high level and get a very early level of feedback. And all the people she spoke with, they were all very excited about this idea. So this was just to give you in perspective that after understanding the business idea, after understanding the business model, we then in collaboration with the person put together the different type of technologies and platforms and products this person would need to bring that vision to life. So a SaaS platform to build the tool online. It's almost like an aggregator tool. Then to bring together a payments technology tool, which will be able to send and receive payments from the platform. Then to be able to bring a financial services partner who would be able to provide, co-branded rewards programming for this particular business. Then also be able to provide a mobile app for the users, both the suppliers and the customers, to be able to have a seamless experience by using a mobile app and interacting, right? So again, slightly long answer to your short question. The idea was to assess and understand what this model would need, look at appropriate tools which are available out there in the market, and also assess the need of how all of this would be stitched together, almost like multiple components, to make a bespoke, unique solution which would work in this case for the business owner and also for the users.
So to maybe continue with your example, I mean, what are we talking about from a time and money perspective to build something like this? You're right. You have to hire. I mean, you're non-technical. You're hiring people, or you're going into partnership and providing equity to a technical co-founder, and then you're kind of aggregating these vendors together. I mean, are we talking millions of dollars in a year, 2 years to get this on board, or are we talking hundreds of thousands of dollars in a matter of months? I mean, what can someone expect? What's realistic when building
So I'll
something of
give
that
you, I
caliber?
mean, without diving into and without, of course, sharing any confidential information about the business, but to answer your question, in this particular example, the outcome was the latter. So this, I think, costed the person in the range of, I think, 150 to, it was less than $200, $200,000 for sure. I don't remember the exact number. It was, I think, in the range of 180, 190 something. So in this case, what we did is we brought on board a technical co-founder who worked with this business owner as on an equity and revenue sharing arrangement. So there was that component. Then we also brought in a couple of technical developers and an external service provider company, which built some components as well. So it was a combination of bringing on board a technical co-founder with equity, bringing on board some credible and genuine service providers against a certain rate card to build the product, also combined with, of course, our services of strategic planning and model building and putting it all together. So yeah, I would say this was, I would say, under 200,000, and this entire journey took us 5 months, I think. We were able to, like, from the first time the person spoke with me and to the time we were able to launch the platform with the business, etc. I think it was in the range of about 5-ish months, under 6 months for sure.
Yeah, so maybe just to kind of round out this conversation, right? If you want to build something like this, we're talking months, maybe years, and then you don't like that's all time you don't have revenue from this, right? So it's almost like a sunk cost to then make revenue later on. I mean, is that just a realistic expectation of what it takes to start this type of product? It is that also maybe a reason not to go down this path is because you may spend a lot of money on something that does not make you money in the long term. I mean, how do you think about that when you're working with founders? Maybe this specific example or in general, right? It's a big undertaking. It's a big risk to go down this path.
So I think that's a very it's a very broad question, Connor. I think I would probably slice it into maybe 2-3 different parts. So in this particular example, the person ran a business and they had capability to invest money to build a platform, the vision that they had, right? So they had run a successful business for over a decade, and they had multiple sources to build it. Uh, so I wouldn't probably use this as the best example to your question, but I do come across people who have fantastic ideas and they're actually solving some genuine problems, but they do not have the money to put into it. And this is where we try and find the best way possible from a bootstrapping perspective, and also utilizing sort of diverse sources of funding, namely crowdfunding, resource funding, rewards based funding, a buy now, pay later kind of funding, where there's a genuine idea. I'll again give you an example. Again, this is a person I have not worked with directly, but I know very closely because they are part of my network. So they came up with the athletic apparel concept for a particular type of martial arts sport. And a very specific martial arts sport did not have a bespoke apparel that the participants could use. So this person came up with an idea. The person themselves is a martial arts expert and instructor. So they came up with this idea and bootstrapped completely, because this person did not have any funding, did not have any background of business, was actually in a completely different industry as far as their day job was concerned. But out of passion, they were into martial arts as well. So what this person did is they went out and they worked with a Kickstarter campaign and similar crowdfunding campaigns to raise money to actually manufacture the apparel and those kits that would be required for this particular martial arts. And I can't give you too much details because I'm, of course, speaking on behalf of somebody else. But to give you an idea, that VC funding and angel investment funding is not the end of starting or doing a business. First off, we look at the bootstrap capability and the founder's own financial resources, which could go into the business. And then the next steps are look at friends and family support, look at angel investing, and also look at diverse sources of funding. There are lots of government grants available out there for specific purposes, specific industries. If you're solving problems in a certain category, for example, medical technology, educational technology, clean tech, health tech, there's a lot of government grants available out there. And if you're not operating in those areas, there are also opportunities available. Let's say, for example, retail, where you are developing a product or a merchandise, to be able to take benefit of crowdsourcing and crowdfunding platforms, where you are able to use your prototypes and your initial design to bring in customers. So there's a lot out there, and our approach, and as a company, and my approach as a strategist, is very focused on looking at all possible opportunities, looking at all possible avenues, because we genuinely want our founders to succeed. We genuinely want our startup founders to build great businesses. So we try and look at all possible opportunities, and even if they do not have sufficient cash, we try and figure out what could be the best combinations to bring in some cash. Of course, founders' own financial resources is a great place to start.
So it sounds like you're basically saying, hey, that there's a lot of options for you. You don't necessarily need to go the VC route, or there's options to secure funding that kind of lower the risk, or put the risk onto somebody else, that allow you to try your opportunity and push forward, essentially.
Absolutely, absolutely. In fact, I would go a step further to add that when we advise our founders to go to VC is only at post seed and when they are ready for Series A. So, what does that mean? That VC kind of funding is ideal when you are scaling. When you are building and when you are launching, building, doing your MVP, doing your first stage of the business, excuse me, then we do not advise them to go to VCs, because the VCs have their own investment criteria and their portfolio criteria, and it is driven by ROI. Right? As a starter, as a founder, when you are building your business, you do not have a guaranteed ROI. And that is why other diverse sources of funding are more valuable to you rather than taking on a debt from a VC, because there is a ROI metric and an ROI component behind that, and there are timelines involved. There are VC money is not cheap. VC money comes with a lot of pressure and timelines. So we generally advise people to look at VCs when they're scaling, when they have sort of when they're building a bigger car. It's like when they're trading in their small car for a bigger car. That's when we advise them to work with VCs.
And so, how often are you seeing people making the mistake of trying to go directly to a VC? I mean, is that happening with the majority of people that come to you, and then you need to kind of
Yes.
course correct, or is it not as often?
Short answer is yes. We see that almost every day. People have this, I don't know if infatuation is the right word, but we see a lot of founders infatuated with this idea that I am building a business, I'm going to go and make a pitch to a VC, and a VC is going to write $1 million check to me. And very, very soon and very, very quickly, that bubble is bust because VCs don't write $1 million checks for ideas on a piece of paper, right? They would write you a check if you have a tangible, scalable, revenue making, profit making business. So yeah, to your question, it happens every day. We course correct, we dive deeper into it, we look at their funding needs, and we look at different options.
So let's maybe just continue here. I mean, let's say you're at a point where you are ready to scale, you are ready to approach VC and try and secure some VC funding. What are the biggest mistakes you still see for businesses at that point that are making it difficult for them to find, the right VC or the right amount of funding? What are they not doing that they should be doing?
It's a very good question. I think there are maybe two different components or two different sides to it. One is founders believing that they have a great product and any VC should write them a check. VCs don't invest just in the product or just in the uh, um, service that you're building or the company you're building. VCs 99% of the times invest in the person. So the person who's the founder or the co-founder, the team, their credibility, their capability, how clear they are in terms of the business they are building, what has been their traction, what has been their own investment into the business in terms of time, effort, money, and skills is very important. And the second mistake that I see quite often people make when they're ready to scale is try to, like, or rather, I should say, not trying to understand what the VC is looking for. So, different VCs have different portfolio categories, different VCs have different interests and domain interests. So I'll give you a very broad example. Let's say this person who was building a beauty products platform, if that person went to a VC where their entire portfolio is sustainable clean energy, it doesn't add up, right? Because the VC who's focused on investing their money on companies which are working on sustainable clean energy has no interest on how, no matter how brilliant your product could be in the beauty industry, there is no match of interests and priorities there, right? So that's important to understand, and that's a mistake we see quite often. That even the founders understand their product, they understand they have put in a lot of money, they have great pitch decks. They end up almost doing cold calling to VCs, then it's almost like they try and throw all the spaghetti to the wall and see what sticks. So we advise them not to take that approach because it's a very bad idea to try and sort of waste your energy and the VC's energy where there is no alignment. So it's like we almost go into a very targeted, very specific, research-based approach of trying to find which VC to talk to. Don't talk to everybody.
So, if somebody's employing your method, the research-based approach, I mean, are they still, what's the expectation? Are they still, and let's pretend they have a viable business that's ready to scale. Are they still expected to pitch 20 VCs before securing funding, or are you saying, "Hey, let's pick these 5 and I'm pretty certain based on where you are with your business you'll secure." I mean, what's just on average, like what can a founder expect in that situation? Are you pitching VCs for months, or if you have all your ducks in a row, is it relatively easy to find that match and then move forward?
So typically, I would give you, and this may be a very high level generalization. What we see is that typically, if you are in the post seed stage, you're raising your seed capital, or maybe going towards a Series A, perhaps, or early Series A. There have been so many categories now. Uh, Perhaps looking at 20-ish VCs to get a positive response from at least one or two is what the averages we normally see, and it takes, of course, definitely a couple of months worth of effort. I wouldn't say a year, but at least closer to that, under a year to kind of get there. But if you are in a larger scalable model where you have done, let's say you are post Series A and you're looking at raising, let's say, a couple $100 million, or maybe let's say 50, 40, 50, $60 million, and you are in Series B almost. There, I think you probably don't need to talk to 20. Maybe talking to 5 or 7 gets you a solid response from at least one. So to your question, the conversion ratio or the number of people you will reach out to versus the number of people who will give you a positive response, I think it depends on the stage as well, right? So if you are like really early stage, pre-product, pre-traction, that number could be in hundreds. If you have revenue and traction and you are in a post-seed, late seed stage, perhaps 5% would be your conversion rate, 5 to 7%. And if you are in, let's say, a larger further more mature and advanced stage, going to Series A, perhaps 10%, 20% could be your conversion.
So let's talk post funding. Let's say you were able to secure that funding from a VC specifically. I think you talked about it a little bit earlier, kind of the downsides, but what is it like once you've received the money? I mean, what you've talked about timelines, metrics. I mean, how much control does the VC have? How does it change how you operate your company? Obviously, you've needed this funding to go from point A to point B or wherever you want to take your business, but now you've taken on this new partnership or relationship. And in your experience, how does that change things?
So the short answer is it depends. And the long answer is that if you have all your ducks lined up, if you have all the things going on for you, you were able to get a VC who is aligned to your domain and industry, and you have got the right portfolio alignment as well. Our biggest advice to founders is to consider VCs as allies and mentors. Because if you start looking at VCs as just a lender of money to you, then that situation becomes a little bit more difficult and tricky to manage, because then you're under that constant pressure of trying to be answerable at every step of the way. And you have a lot of pressures in terms of metrics and returns, etc. But I think if you've gone through the organic route of finding the right person who is aligned to your approach, aligned to your purpose, and the portfolio is aligned with them as well, more often than not, the VCs would act as your allies and mentors, and working alongside with them to build the business with their support goes a long way. And I think you have then a more almost like a co-working relationship with them, and you then are not sort of feeling the pressure or under that pressure of being answerable at every step of the way. Then you are almost collaborating at every step of the way. So that's a huge differentiator, that you choose to work with somebody where you are under a pressure being answerable and being accountable every step of the way, or you are collaborating every step of the way. Having said that, of course, by making friends with the person who's in the VC side of the table does not remove the accountability. You're, of course, accountable for the business's success and profitability and returning the money, but the journey becomes much more, I would say, livable and enjoyable, and if you take the collaborative route. So yeah, it depends largely on your direct working relationship with the firm or the person who's investing in you.
And how much leverage or control does a VC actually have, right? Because, and I don't know the specifics, but it seems as though, they're taking a big risk, a big bet, and in many instances giving certain businesses and certain founders millions of dollars, right? So while they will tell you, hey, we want this ROI by this date, I mean, there's nothing that can be done to guarantee that, right? Like, so is it more that they try to exert control that they don't theoretically have? Or, I mean, how does that work? Like, they're just putting their money up and essentially risking it on an investment? Um, and
So
there's no recourse, right, to get that money back. Once it's been given, it's like, okay, we're placing a bet here on you and the team to execute, but it may not happen. And I think you hear the general metrics every time about the number of startups that fail, right? Or the typical makeup of a VC's portfolio, right? Where one or two companies provides that outsized return while everything else has provided little to no return.
Absolutely, you're absolutely right. I think the general norm is about 80% of the startups would fail, and I think VCs understand that as well. And like you rightly said, they are taking a bet by putting the money into your business. So they are already aware from their portfolio strategy perspective and from their fund perspective that every investment is not going to give them returns. They're already aware, right? But at the same time, it does not remove the accountability for the founder who has taken the money. And more often than not, 99% of the times, I would say, the VC would place a person or one of their employees, associates, partners, whoever, depending upon the size and structure of the VC. They will place a person from their organization onto the startup as a board member. And being a board member or having a board member on the startup team always ensures at least some level of monitoring, some level of discussion, some level of ongoing collaboration, some level of ongoing understanding of what's happening in the business. How are they progressing with their production? If there is anything being produced, or their traction, their customer metrics, their revenue metrics, their profitability, their return on investment on a sort of periodical basis. What I normally hear from my VC friends is that they typically do a monthly check-in. The board member, the person who's part of the board of the startup, they would typically do a monthly check-in, or at least a monthly sort of a review of information with the startup team to have a very clear understanding of where this business is going. And assumingly things are going well, you just do like a quick review, understand everything is going fine, and you're okay. But if you tend to see that things not going well, or if there are some areas of discussion, correction, you get into those conversations as well. And that's why VCs tend to have a person on the board most of the time. And having said that, even having that, all those checks and balances in place, bottom line is 80% still fail. And, and that's the nature of the beast.
Yeah, so let's. I'm kind of curious to like put ourselves in the VC's shoes, right? I'm assuming they're getting dozens, if not hundreds, of businesses coming to them. Hey, check out this idea. Check out this problem I want to solve. What is the selection criteria like on the VC side? And I think this may help founders as well. I mean, how do you deal with such a large volume of options to then, as we were just talking about, say, yeah, this is the one. This is the next Airbnb or Uber or whatever it is that is going to provide that outsized return.
Sure. So there are, I would say again, there are two parts to it. One is the entire sort of application and pitching process. Depending upon which VC you speak with and depending upon their size and scale, they would have certain processes in place to review and understand and assess the applicant. And the applicant in this case being the founder or the founder company, right? So they would have almost like a job application process where you submit your idea, you submit a couple of prototype pictures or Figma wireframes, or you submit a couple of videos, demonstrations, artwork, etc. And then it goes through a funnel of people who evaluate each of these ideas. Most likely, there's a human being or a team of humans who would evaluate each idea and then pass it further for, let's say, the next round. It's like a junior recruitment person passing it on to the senior recruitment person in the job application process. And once you have sort of gone through this first stage of funneling or filtering, whichever way you look at it, then comes the filtering from a VC's methodology and portfolio and size of the ticket perspective. So, for example, if we go back to the beauty products company pitching to a clean tech energy VC is concerned, most likely than not, they will get filtered out in the first stage itself because it does not meet their criteria from a sector, domain, industry perspective, right? Now, let's assume there's another company which is building a clean tech product or a sustainable energy product, and they come through their funnel They would look at the idea, they would look at what they're building, they would look at the, if there is a wireframe or a design, they would look at that, and then they sort of get shortlisted and passed on to the next stage, where either the venture associates or the scouts, whoever are responsible for evaluating further, will dive into the specifics, which would be the specific product, how does that work, what's the typical problem they're solving, is the solution scalable enough, what's their financial projections looking like, what's the revenue projection looking like. So I think that would happen at the next stage. And then from there on, again, I'm giving the example of a job interview process, that after you have been filtered at two stages, then comes a meeting scenario where somebody from the VC team, typically a venture associate or a venture partner, will meet the founding team and understand them a little bit more, perhaps do some live demos, perhaps do some virtual demos, etc., and then get talking a little bit more further. And there'll be a couple of more rounds of discussions, closed room discussions with the venture partners, general partners, limited partners, senior partners, etc., etc. And I would say almost towards the end of these multiple discussions, a consensus, a joint decision will be taken to say an agreement or a decline, at least in an early stage. And then, of course, there are more steps to the process in terms of financial due diligence, legal due diligence, corporate structuring. I'm sure you would have heard about the terms of cap table and term sheets. And this is where the cap tables and term sheets start getting formed and starts getting scrutinized and discussed further. So after a very early and initial discussion and agreement with the VCs, typically the conversation would go into the cap table and term sheets, and they will go from there in terms of, okay, what's the actual viability looking like after passing through the due diligence, and after sort of, like, it's almost like going towards, again, the example of a job offer, typically going towards doing your background check and doing a offer in a, like an offer in early stage or offer in principle, to say, hey, here are the terms and conditions of your employment. So I'm just giving that example because people generally understand, if they have applied for a job, how that works. So just from that perspective. But yeah, there is a whole bunch of filtering, assessing, evaluating, and sort of building that consensus within the team to say, okay, whether we are going to work with this company and this founder or not. And then, of course, there are lots of legal structures and legal processes to be followed.
So for those that make it through to those final stages, past through that whole process, through all that filtering, they're meeting with partners, senior partners, as you discussed.
Mm-hmm.
From your experience, I mean, what is that? Let's just say there's two companies that are solving the same problem, and the partner needs to make a decision. I'm going to either invest in company A or company B. From your perspective and your experience, I mean, how do they typically make that decision? Is it made on a gut feeling at that point? I think you mentioned earlier, like, hey, we just like this team better, or they, for whatever reason, there's a subjective, they present it better, or they carry themselves better. I mean, does it come down to that often in your experience, or is it more nuanced than that?
It is certainly more nuanced than that. In my experience, I haven't come across scenarios where two people or two companies building the similar product reach that stage. Typically, what would happen is one of them would have been filtered out in stages before that, because of the differentiation in the product, or the differentiation in their revenue modeling, or differentiation in their approach, or the actual tool itself. So it's very rare that two people building the same thing get into the room with a decision lying upon the partner's finite wisdom, right? So it's almost like if the founder of Uber and founder of Lyft were in the same room. That's a very rare scenario. Having said that, if you were to assume that a partner is actually reviewing two solid, viable businesses which are very similar in nature, I think there'll be more nuances applied. The due diligence of each company, the financial modeling and structuring of each company, and also from an investor's point of view, from the venture capital point of view, what is the term sheet and cap table looking like? Again, sometimes the partner can take a view that, hey, this this structure and this term sheet and this cap table is more favorable to us as an investor. Maybe that can be a criteria. other person, another scenario could say, hey, I know this company is offering me a better offer as an investor, but I like this company better because the founders are more, experienced, more knowledgeable, better skills. They have better referrals and better networks. That could also play a huge part. That one person may have not had a good social proof or social presence. The second company or the second group of people may have had some great social references, some great social proof to say, hey, oh yeah, I know this guy. John referred him, or Jim referred him. So yeah, I know Jim, I know John, and they both said he's a good guy. So I'm going to believe that he's a good guy rather than believing this person who's almost a stranger and I don't know very well, but maybe they're offering me a good deal. So it depends, is the short answer, based on partners' preferences, based on individual social proof, based on moment in time. So, yes, there is a lot more nuance to it than a binary answer to it.
One thing I want to pick your brain about is kind of like the democratization of technology and maybe how VCs are thinking about this. And you can tell me I'm wrong, but I've just read online or generally there's an understanding of, and you kind of mentioned it earlier. Hey, we're giving you $1 million so you can hire the team to build this software. But as technology advances, artificial intelligence and that actual R&D coding perspective, the lead time becomes shorter, the cost to build it becomes cheaper. Essentially, everybody has access to these same tools to build a similar product in the same amount of time. I mean, is that on VC's radar? Are they thinking about this in any way, or is it going to change strategy going forward? In that, hey, because of technology, we may not need to invest 5 million into this company. We only need to give you 1 million. I mean, and then maybe one other piece. That's the first part. And then how do you look at it from a competition point of view, right? Anybody today, another example, you talked about the MMA apparel or whatever it is. Anyone today can start a Shopify store. Anybody today, because of technology, can connect with that supplier on the other side of the world to basically build the same product. So kind of a two-part question, but how does that affect the investability of startups? And then also as a founder, I mean, how do you think about that when now it's great that this technology is available to you, but it creates a lot more competition?
I think you're absolutely right, Connor, that democratization of technology has only gotten better and improved over the recent years. And you're absolutely right. Most of the investors I speak with, the technology is not the primary criteria they look for anymore. And in the recent years, what I have seen is investors have sort of moved away from looking at proprietary technology being their primary reason to invest. So you're absolutely right. Anybody can copy anything, right? What investors, in my opinion and in my experience recently, are very focused on is the problem you are solving. So it's the problem of accessibility and availability, the problem of time and efficiency, or is the problem of cost and scalability. It's no longer about, oh, you got this brilliant, shiny tool with all the bells and whistles, and I'm going to invest in that tool. That does not happen anymore, at least what I am seeing around me. People are now very focused on the specific problem you are solving. Are you making a particular service or a particular tool available to people who do not have access to it? For example, like I'll give you a very, very broad example. There are probably 500 banks around the world, but there are still fintech companies growing and thriving and new ones coming up every second day because every bank is not focused on accessibility of their products and services in every corner of the world, right? So for example, I recently worked with a fintech founder. They have built a product for foreign exchange remittances, money transfer in, money transfer out, for a particular part of the world where banking is not accessible to the people living in that community. And it's not a it may be a global problem because there are lots of communities and cities around, or towns or villages around the world, where they do not have access to a branch or a banking house or something of that nature. But there are companies out there who are focused on that. So this is an American company trying to solve a problem for a community which is not in America. It's in another part of the world, but they have a product which has thousands of users, is revenue making, is profitable for that community. So just to give you that example as well, that yes, technology is democratized. Yes, people are no longer looking at a proprietary technology, but now the focus gradually has shifted towards the problem you're solving, the solution you're providing, and the scalability of that solution. And that gets the investors going.
Okay. And just to kind of go back to the beginning to round us out here with a couple questions. You mentioned this earlier. There's a lot of different ways to secure funding for your business, especially if you're not in that investable space where a VC would actually be interested. So maybe in your experience, and again, you listed a few of these earlier, which is the best option or the most popular, the most often chosen option from founders that you work with? I mean, you mentioned crowdfunding, grants, using your own money, friends and family. I mean, where do you see people go most often when they need that initial funding for their idea or business to get off the ground?
A combination of bootstrapping and friends and family still sort of continues to be the go-to option for most startup founders that I see, because it's a very sort of perhaps a philosophical thinking that if you won't invest on you and if your family won't invest on you, why would a stranger invest in you? It's almost that, right? So that's what I see a lot. Generally founders, whatever limited resources that they have, even if it's a couple of $1,000, a couple of $100, whatever it is, start with that and then sort of convince the immediate next circle of people around them, which happens to be friends and families around them, to support and sort of increase those couple of $1,000 to maybe $100,000 or a couple of $100,000. And then once you have built something, once you have created something, once you have demonstrated that value, that's when the circles go bigger and bigger and bigger. And hopefully you reach a point where you're ready to go and talk to a VC. So yeah, friends and family and bootstrapping is definitely the way to go, at least to start with.
Okay, to close this out here, one final question on your entrepreneurial journey or your career journey, however you want to think about it. What's the best advice that you've ever received?
So I was a corporate slave. I was a corporate banker for 20 plus years. And I think the best advice I have received from my bosses and my supervisors and managers I have worked with in the banking world is keep persisting, keep looking for answers. And that was the best advice I got, because I worked with great bosses and everybody was like very, very determined to solve the problems for the community, the customers, the economy, the environment, the people we worked with, the customers we worked with. So they would always press us to keep looking for answers and keep looking for solutions. So that was one of the best, I would say, learnings and advice I've had in my career, in my banking career. And sort of the other sort of related point I can suggest here is, as an entrepreneur, as a founder, I have almost inverted that advice to say, as a founder, that everything is figure outable. That's the advice that I work with, or that's the motto or theme I worked with as a founder and as an investor and as a startup builder and as a consultant, whichever way you look at it. That after my corporate career, that has still stayed with me to keep looking for answers. And even if I am not looking and digging for answers on my own, as a founder, I bring people together, I bring teams together, I bring various skills together, and I kind of work with the philosophy of that we are all in this together, and it is all figure outable. So let's go figure. And that's what I
Yeah,
advise to the founders who I work with as well.
I think that's a great way to close. So I know you got to run, but hey, I appreciate you taking the time to do this. I think it was a great conversation. I was able to learn a lot, and I wish you the best of luck in the future. But to close us out, I'll give you the floor. Where can people find you, find out more about what you're building and how they can work with you?
Sure. So first of all, thank you so much for the time and the opportunity, Connor. Love the conversation. I love this chat. I am available online. So LinkedIn is the only social media I use. I don't have any other social media handles. So reach out to me on LinkedIn, Prashant Agrawal, or if you just go to my website, it's www.prashant.cc. That also links back to my LinkedIn. That's the easiest way to find me. And like I said, that's the only place I am on social media. So available there all the time. Uh, I am currently building a fire starter we have launched just last month. It's called Be Pacific. And this is a fire starter where we are working with startup founders on a one on one basis, trying to sort of ignite their fires and ignite their passion in building very cool businesses. So I have a group of people who are working alongside with me and a bunch of great partners where we are trying to help people get to their monthly revenues and investability and build their successful roadmap. So it's really exciting. I am looking forward to it. We have some great businesses in the pipeline. So more than happy to connect with anybody who's interested to learn more, chat more, or learn from our own mistakes. Happy to share our mistakes as well. So yeah, ping me on LinkedIn. That's the easiest way to find me.
Great, Prashant. All that'll be linked in the description. So, hey, thanks again. And yeah, best of luck.
Thank you, Connor. Lovely talking to you, and I'll chat with you hopefully soon again.